In October 2008, an entire nation went bankrupt. Not a company, not a bank, but a asterisk country asterisk. Iceland, a remote island of fishermen and volcanoes, suddenly found itself at the center of the biggest financial collapse per capita in modern history. Its currency lost half its value. Its three biggest banks imploded, wiping out billions overnight, and its people woke up to discover their entire economy had vanished. How does a tiny nation, once hailed as one of the richest and safest in the world, go from prosperity to ruin almost overnight? Today, we unravel the unbelievable story of how Iceland's dream of becoming a financial powerhouse turned into a nightmare, a warning for every modern economy that thinks it could never happen here. Before the chaos, Iceland was simple, even peaceful. For centuries, its people lived off the sea. Fishing was the heart of everything: the economy, the culture, the survival. By the late 20th century, Iceland was small but successful. With a population barely over 300,000, it had one of the highest living standards in the world. But behind the calm, there was ambition. Iceland's leaders wanted more than fish and tourism. They wanted to turn Iceland into a financial hub, a Nordic tiger like Ireland or Singapore. So in the 1990s, Iceland began to change. It joined the European Economic Area, liberalized trade, and most importantly, it deregulated its banking sector. That's where everything began. In 2001, Iceland privatized its major banks. Kaupthing, Landsbanki, and the government sold them to private investors, promising competition, innovation, and global opportunity. But what no one realized was that Iceland's new financial system was built on quicksand. Once privatized, Iceland's banks went on an astonishing spree. In just 5 years, they grew from modest local lenders to global giants. By 2008, their combined assets were worth 10 times Iceland's entire GDP. How? By borrowing a lot. Icelandic banks raised massive sums from foreign markets, using that money to buy foreign assets, invest in real estate, and even purchase entire companies abroad. It was an illusion of wealth, a bubble powered by cheap credit. In Iceland, people felt unstoppable. Young bankers, many barely in their 30s, were called the Vikings of finance. They strutted across Europe, buying up banks, football clubs, and luxury brands. Reykjavik was booming. Money flowed freely, and everyone seemed rich. The stock market quintupled. House prices soared. To outsiders, Iceland looked like a miracle. But inside the system, cracks were forming. By 2006, economists began to sound alarms. The numbers didn't add up. Iceland's 3 banks had borrowed hundreds of billions of dollars, while the entire nation's GDP was barely $20 billion. That meant, if the banks failed, the Icelandic government couldn't possibly save them. The central bank was tiny, its reserves minimal, and its currency was fragile. Still, few listened. The bankers brushed off critics, and the government reassured citizens that Iceland was financially sound. But they weren't. They were addicted to debt. And by 2007, the world was starting to change. When the U.S. housing bubble burst, it sent shockwaves across global markets. Credit dried up. Investors panicked. Suddenly, Icelandic banks, which relied heavily on short-term foreign borrowing, couldn't roll over their debts. They were locked out of global credit. By early 2008, the Icelandic krona was collapsing as foreign investors dumped it. Inflation surged. And then, the impossible happened. October 2008. Lehman Brothers had just fallen. Global panic was spreading. In Reykjavik, the government tried to keep calm, but Iceland's 3 major banks were on the edge. On September 29th, Glitnir couldn't refinance its loans. The government announced it would take a 75% stake. Markets panicked. If one bank needed rescuing, the others must be next. Within days, the krona crashed 50%. ATMs ran out of cash. Supermarkets saw runs on food. Then, Landsbanki fell. Then, Kaupthing, the largest of them all. In just 1 week, Iceland's entire banking system collapsed. The government took over, but it was too late. Foreign deposits, especially from the UK and Netherlands, were frozen. Britain, furious, invoked anti-terror laws to seize Icelandic bank assets, putting Iceland on the same list as Elk. For the first time in modern history, a developed Western nation was bankrupt. The effects were devastating. The krona lost more than half its value. Inflation exploded. Businesses went under overnight. Unemployment tripled. Thousands lost their homes, their savings, their pensions. So Iceland turned to the International Monetary Fund, the IMF, for a bailout of $2.1 billion. It became the first Western country in over 30 years to seek IMF assistance. In exchange, it had to impose austerity. Tax hikes, spending cuts, and currency controls. But the Icelandic people didn't stay silent. In early 2009, tens of thousands took to the streets in what became known as the Pots and Pans Revolution. They demanded accountability. Eventually, the Prime Minister resigned, the first world leader to fall as a direct result of the 2008 financial crisis. Unlike most countries, Iceland did something extraordinary. It didn't bail out its bankers, it prosecuted them. More than 24 top executives were charged with fraud and market manipulation. Some were even sentenced to prison. But justice couldn't erase the scars. Still, something remarkable happened. Instead of protecting the banks, Iceland protected its people. The government guaranteed domestic deposits but refused to repay billions owed to foreign investors. It was controversial. Britain and the Netherlands sued, but in 2013, Iceland won. The court ruled it didn't have to repay the foreign debts. The small island had stood up to global pressure and survived. By 2011, Iceland's recovery surprised everyone. Its economy began to grow again, faster than most of Europe. The weak krona made exports and tourism far more competitive. Many citizens had their loans written down, and capital controls stabilized the economy. Within a few years, Iceland repaid the IMF ahead of schedule. Unemployment fell. Tourism boomed. The island that went bankrupt had somehow bounced back. But let's fast forward to today. The world is once again awash with easy money, speculative bubbles, and overconfident investors. From cryptocurrency manias to housing booms, from meme stocks to debt-fueled governments, the patterns are hauntingly familiar. Global debt now exceeds $300 trillion, far higher than in 2008. Financial assets are growing faster than real productivity. And once again, people believe the system is too advanced to fail. That's exactly what Iceland thought. The lesson of Iceland isn't about a small country mistake it about human nature. Our endless confidence in the illusion of growth, our belief that we've mastered risk, and our refusal to learn from the past. So, what are the takeaways? First, growth built on debt is not real growth. Iceland's banks grew 10 times the size of the economy until the illusion broke. Second, accountability matters. While most nations rescued their banks, Iceland held its leaders responsible, proving justice in finance is possible. And third, crisis reveals character. Iceland chose to protect its people over foreign creditors. It paid a heavy price, but it preserved its democracy and integrity. History doesn't repeat, but it rhymes. The Icelandic Meltdown was a small-scale warning, a glimpse of what happens when greed, leverage, and blind faith collide. If you found this story fascinating, hit subscribe and join us as we uncover the forgotten collapses, manias, and scandals that shaped our world. Because history doesn't just live in the past, hides in the shadows of our present.